Hey everyone, hope you're having a good day. My name's Andy, channel's Finding Value. Today we're going to go over a couple of questions that some people had put in the comment section on the YouTube videos. And I just grabbed those comments or questions, threw it in Word so I can answer those. And this is very similar to what a question and answer session would be with people asking a bunch of different questions. I usually have something at the beginning of those question and answer sessions that also goes over information that pertains to the commodity bull market or information on cycles or something like that at the beginning. But a lot of people write in questions, and these were questions that I had gathered from YouTube comments. And every once in a while, I go over them. I used to go over them more so historically, like back in the day, a few years ago, before I had the website going. So let's dive in. Let's take a look and see what people are commenting. And then I'm going to put opinions on those comments and share my opinions with that. So we're going to start here. It says, for someone newish to investing with a smaller portfolio, does it make sense to trade more frequently? I sold some of my oil gas producers and reinforced my precious metals, mostly physical. Seems reasonable given that it appears a slowdown is starting. Would love to get others' thoughts. Um, my opinion is I would not trade more frequently. I would trade less frequently. Like I wouldn't try to increase anything. In the short term, what you are actually trading is emotions of the market. It has nothing to do with the fundamentals of the market at all in the short term. So when price moves up and down, it is based off of sentiment changes and money flows in the very short term. Those movements can be based on anything. They can be based on news flow. It could be based on people deciding to sell because they think a recession is going to be here. It could be a whole variety of different things. People timing recessions have been pretty poor. Peter Lynch, Warren Buffett, a lot of these guys, Howard Marks, they say that it is not possible to time a recession. And when exactly, with any sort of precision, can anyone make a call and get it right consistently? So a person can make the call, they can get it right once, but not, I don't think anyone's made a call right twice with any sort of precision. So what they would say is timing the market in the short term is the worst thing that you can potentially do. And what you're asking is, does it make more sense because you don't have a large portfolio to trade more frequently? No, it doesn't. Completely the opposite. And I'm not saying that people with bigger portfolios should trade more frequently. You should be exactly the same, irrespective of the size of your portfolio. So if you have a big portfolio or a small portfolio, you would adopt the same strategies. You still want to look for asymmetric opportunities. And asymmetry is big upside and very small downside risk. You're looking for things that are out of favor, and you're waiting for the inflection of sentiment, short-term sentiment, and or the inflection of earnings of those companies, depending on what you're looking at, to come into favor. And that doesn't occur in the short term. So you're going to have to wait for years for that to play out. And people are going to say, well, I don't have time to wait for years. My response would be, you shouldn't be in the market, period. If you don't have years to wait, you shouldn't be in the market. Short-term market timers don't make any money. They generally lose money, and the shorter the time frame, the higher the frequency of losses. So day traders, like 99.9% of day traders go broke. And then as you lengthen the time frame, swing traders are less than that. So they're more successful because their time frame has been expanded. And then you go all the way out. And then you have people who say you should never sell anything, like Warren Buffett. And he says that he would be far richer if he hadn't sold a lot of his companies versus the ones that he has sold and tried to market time with. So you've got this wide variety of opinions on holding like a 10-year, 15-year, 20-year time frame, and then Buffett holding, saying, you know what, do a bunch of research up front, buy the company, hold it forever. But he's in certain particular companies that go up over long periods of time. He's not in a cyclical company or a company that has cycles that go in cycle and out of cycle. Those you're going to have to sell at some point. But those cycles generally last pretty good long time, 5, 10, 15, 20 years even, depending on what you're looking at. So I would try to hold for the entire bull market. If you try to short-term trade, another thing that you have to take into account is taxes. And if it's a small account and maybe you don't make a lot of money yet, but taxes will eat you up. And I pay a lot more attention to taxes today than what I used to. If you make a good amount of money and you make a lot of money on your investments, a short-term trade that is held less than a year, you have to pay a lot more in taxes than you do on a long-term trade, which is held for over a year in a taxable account. Even better, you're going to start looking at your accounts and how to deploy money into certain accounts like Roth IRAs, 401ks, or Roth 401ks, or whatever it is, where you're going to diversify your accounts with some pre-tax money to reduce taxable income for today, and then post-tax money that can grow tax-free in the future. And I do a combination of both of those things. If you're trading in the short term in a taxable account, you're going to pay a lot in taxes. Specifically, if you make a lot of money, you're going to pay a lot of money in taxes. And trying to trade in the short term means that the pullback is going to have to be greater than what your tax outlay will be if you're trying to trade short term. And some people are in brackets of 24% tax or higher. That means you're going to have a pullback that's greater than 24%, and you're going to have to time it pretty well. So if some of these have 30, 40, 50% pullbacks and you miss the exact top, more than likely you're not able to time it well enough to cover even your taxes, the tax difference. So it'd be better to hold it and then figure out ways to hold on to that thing and have it grow if it's in your taxable account. So it's a lot deeper than just trying to make the most amount of money and then getting absolutely raked over the coals with taxes. So that's also things that I look at. But in my opinion, overall, I would not um, trade more frequently. No, I think it's absolutely the worst idea, in my opinion. Can you look at your AX? It's a 2 times ETF. What does that mean? What is it? How does it work? If I'm bullish on uranium, does this make more sense than URA divided by URNM, or either one of those, I should say? Here's URAX. There's URAX. It is a 2 times leveraged ETF or ETN. Does this make sense? So the members know what my opinions are on leveraged funds. No, do not do them. Get rid of it. If you're going to do something with it, use it for shorting. These funds, the way that they gain leverage is generally from, they have to use some sort of, can't tell you exactly what it is. They do something to gain the leverage. That whatever they use to gain that leverage, it's called asymptotically approaching zero. So what that means is that over time, because they're using whatever that thing is to gain the leverage, that they slowly approach zero over time. They all decay. Decay means that it slowly goes down to zero. It'll never get to zero. That's what asymptotically means. Asymptotic in math means it'll go to some area, but it will never reach it, but it'll keep getting closer and closer. The decay in a lot of these funds that use futures contract pricing and these leverage products, I would avoid at all costs. I would not have anything in them. They all decline. So if you were to look, and I'll show you an example, JNUG is a index 2 times share. It used to be 3x. See how it started up here at 38,000 and then it naturally declines to zero. That is the decay over time. So if you guys are trying to play the bull market with these leveraged share, leveraged ETFs or whatever you call it, ETN ETFs, I would not do that. I would avoid them at all costs. do not get involved, in my opinion. Uh, Now, that's not supposed to be meant as advice. That is what I do. So I'm sharing what I would do. What I would do is I would avoid them at all costs. That's what I would do. Coming back to the questions here. Why do you chart the 30-10 long over short, but you chart the 2-10 short over long? It seems like that's likely to be confusing to many of your viewers. Yeah, so what I do is I took the TYX divided by TNX. So that's the 30 over the 10-year. The reason I show it in this direction is because when I compare it to gold, which is your gold futures pricing, it is aligned in the same direction. So when it goes up, this ratio goes up. That is the correlation that I am showing you. So you can flip these up and down. You can have the 10-year over the 30 or the 30 over the 10. The reason I do it this way is because it perfectly correlates with gold directionally. So what this means is that the 30-year is going to be more stable, and when the 10-year goes down, this ratio goes up, and it's in the same direction that gold would go in, and that makes it a lot easier for people to track. And then the 2 and 10 that you have, I just left it as the 2 and 10 because that's what people look at. They look at the inversion of the yield curve, and you can do this the 10 and 2, which is no big deal there either. I must have put it in. Oh, here it is, 10 and 2. And you can do it like the 10 and 2 and have it go like this, which is fine. And it's starting to uninvert there as well. But sometimes when I use my correlations and I try to correlate to other things, I flip them in either direction. So some things, when they're up, they'll be correlated when things fall, and then other things they'll be correlated in the opposite direction. So the reason I flip them back and forth is because I use them in other areas to find correlations with certain assets to see how well they track each other. Think of it as a linear regression analysis, and you plot multiple things on top of each other, and then you get an R squared value. And R squared value is how well do these things correlate together? How well does the projected equation that you have fit the data? And usually, if the fit is really well, you're going to get a correlation that is above something like 80%. Um, and there's a whole bunch of things that they use for correlation, like in psychology, they use IQ as a predictor of, say, wealth, and that might be the highest correlated factor in a person. Their R squared values would be something like in the 30 something percent range. And that's a good correlation for them. In science and stuff like that, a correlation that starts to get to like 70, 80% is a pretty good correlation. Um, GDP to energy consumption is like 99% correlated, which means, and when I say energy, I mean oil. GDP is directly related to oil consumption. Whether it means that richer nations consume more oil or that oil is the generator of GDP, it's kind of, I think, a combination of both of those things. I think it's both of those combined. As GDP increases, they need more oil to continue to increase more GDP. So those are things that I look at. I look at those correlations. I had a class on linear regression analysis. I went through a lot of math and science, statistics. I did a lot of quality control, which also looks at a bunch of statistical analysis, looking at 3 sigma, up and down in either direction. 3 sigma is the standard deviations and the predicted control that you have going out to that degree and what your percent confidence is. A lot of 95% confidence. I also did null alternative hypothesis, on and on and on and on with statistics. And that's what we want to try to apply to the markets to figure out. So let's keep going back to the questions here. More questions. It says, I've watched you for years now. This is the best part of your information. You've tapped into what all of us wish we could do, which is chat about the exact thing you're chatting about. But you're the only one talking. It brings clarity, but I'd love for you to have additional guests that bring some spice, like Neil deGrasse Tyson. As a comedian who is well versed to bring levity to very deep subject. It would be great if you had an InfoWars type guy with a slight comedic side. Yes, it's okay to tell people to sell when we see major moves coming right in front of us. Like when the rate hikes started, or before when they were talking about doing it soon. Right now, we're talking about defaults of the consumers and possible recession. I think it's time for people to sell and come back to buy it for pennies. Here's the problem with that. No one knows exactly when to sell. And there's a huge risk in leaving those stocks. If you sell, it's very hard to get back in if you are wrong and the price goes up. There's two generators of inflation. There's monetary and then there's fiscal. And depending on how large the fiscal deficits are, fiscal deficits means that they are spending more money than what they're collecting in taxes. And right now, they're spending more money than what GDP is. So they're running a deficit against GDP of about 8% right now. That can overpower the market. It's a stimulative factor. Monetary expansion comes from the real estate market. That's where the thesis originally came from, is you've got fiscal and you've got monetary. That is your credit expansion or money in the system expanding. The monetary side is the bank lending. The fiscal side is government spending. And as deficits, I should say, as debts increase, and you've got interest payments and all that stuff on the debt, and as interest rates go up, your fiscal spending can go up. And that can eclipse the monetary side. So you've got fiscal dominance, you've got your monetary dominance. And right now we're shifting into a fiscal dominance world, which can overpower the monetary side. We may not go down in nominal pricing. Nominal means that you won't see the prices drop. But what you will see is that certain assets will outperform other assets as they both go up. So it's possible that technology stocks will underperform because they are overpriced and they go sideways, while commodity prices go way up. The value difference will still move. So commodities will outperform technology stocks as technology stocks go sideways. And they go sideways because of the debasement of the currency and the fiscal spending. That is a possibility. They could also go up still. And I'm proposing that given the market conditions of where we're at, that we could see commodities go up even faster. Now, are we in a slowdown? Yeah, we could be in a slowdown. We could be in a recession. All of those things are definitely possible, but they could be masked by uh, deficit spending for fiscal, and then they overstate inflation or understate inflation, which overstates GDP. They could be doing all sorts of stuff like that in the background, which basically hides a recession. That's very possible. And they print so much money that that money printing overwhelms everything. We don't see an actual decline. Everything still either goes sideways and consolidates or still goes up, even if a recession is there. So I'll say that there. It says nobody talks about refinancing for companies is far more important than the rate. Once again, it's more about liquidity than rates. Still too much liquidity out there for a crash. Well, that liquidity is being provided by fiscal spending. It's fiscal driving. It says try to tell you all oil and housing are crashing. No, they're not. Oil is not crashing, and housing is not crashing. We can look at some data here. Here's Leonard Corp. So does that look like a crash at all-time highs for Leonard Corp? What I think is wrong is housing's not going to crash. And what's difficult is people look for people to agree with them. I don't agree with people. I agree with data. I agree with opinions that make sense, that I think are correct based off of sound reasoning and logic and data. So people think that the housing market's going to crash. I think they're wrong. Why do I think they're wrong? I think the demographic, we're in a very good spot demographic wise for home prices to go up. Now we've increased interest rates to what I think is an unaffordable area. It's going to slow down the market. Okay, now what happens if the market does slow down and unemployment goes up? They're going to lower interest rates. When they lower interest rates, they're gonna basically increase the affordability of the demographic to purchase homes. So what we would see is if we see rates, potential for rates to go down, we should see home builder prices go up. This is Lennar Corp, a large home builder, and what is it doing? Home builder prices are going up. It's the market front running the Fed and about to lower rates, which the market thinks that home builder or housing starts are going to go up. So that's Lennar Corp. We can also use DHI, which is DR Horton, which is another very large company, and this is in a bull market. So it is impossible, in my opinion, for home builders to go up like this and not be in a housing market boom. It is impossible. Last time we turned in 2005 and started to head lower from '06 onward. So home builders crashed before the crash in 2008, and it was very obvious. Here, we've got the exact opposite going on. We have home builders front running a big move in I think sales will go up of new homes, in my opinion, when rates do come down. And that's why the market is forward looking. I think a lot of people, even in the comment section, they use price as a determining factor to create a narrative from. They're not actually using data. They're not using the positioning of the markets. So in my opinion, in order to get a correct view of the market, what you can do is you can aggregate the positioning of the market to determine a to determine something, whatever that something is. So if I think, in my opinion, this is what I think, and this is derived from the market. I think if interest rates go down, and they could go down because of unemployment going up, I think that the affordability of homes is going to overwhelm the unemployment rate, and that house prices, I should say, that new home volume will go up, even if unemployment goes up, because the interest rates coming down and the affordability that is gained from those interest rates will overwhelm the unemployment, which means that there's more people priced out of this market due to interest rates and affordability than the people that would purchase homes that would lose their jobs. And how would I know that? I know that from the home builders going up. And that's the conclusion that I make from the market using data that the market has given me. And then I do that across everything. So if I have a opinion on the market, like let's say that I come to the conclusion that the positioning in oil will go up if interest rates go down. I'm just going to make that up. That's not my stance. I'm just making it up. What we should see then is that the market would front run a potential move lower. Oil would go up before they would lower rates. And if that was the potential case, which it might be, I don't know, that could happen. A lot of things that I have looking forward and the sequence of events that I think is coming is the market's going to go through a slowdown, which I think we're in or have gone through or are going through. They're going to lower rates. We could even see unemployment go up. It's very possible. It's already kind of moving in that direction. And those rates coming down are going to put pressure on the dollar to go lower. When rates drop, and if I were to use the data of what I think could potentially occur, so I'm using the 2-year yield. So when rates drop here, see how they're dropping and they're about to break out. If they continue to drop, that most likely means that we've got some weakness in the market. That's why they're lowering that. When that drops, it's more likely the case that the dollar could drop too. And we lose that support level and we drop down here very easily. What does that mean? Most of the stuff that I'm invested in is priced in dollars. And if the dollar drops because of the lowering of interest rates, I think it's going to be a tailwind behind commodities. Now, that doesn't mean that the price action in the short term will necessarily do that. We could see a first pull move lower because a slowdown is what triggered the move. So if a slowdown comes, people are going to position against, away from commodities because they're going to say reduced demand. But as the dollar drops, that's the denominator in the commodities section. So we would drop first, which would be the slingshot kind of pullback move, and then we would rip. And what would occur is the market would uh, basically heal itself at some point. More bank lending will come into the system. We'll probably see steel and a lot of these base metals start to take off, and then we'll probably see a lot of other commodities follow right behind it. But the sequence of events would be slowdown, lowering of interest rates in dollars start to fall. There could be a slowdown period, and then after that, we go. Now, the timing of it, I don't know the timing of it. We might have already gone through the majority of the slowdown because we've had a big pullback in a lot of these commodities already, and they have bottoming patterns, which you should also integrate into your opinions. So really, what I'm doing is I'm taking the chart patterns of absolutely everything, aggregating all of those patterns together in my head, and forming an opinion. Uh, what's difficult with a lot of these outside people is I don't believe they do that. So I could bring other people on and get their opinions, but I look at them and I just like, you're like 7 steps behind because you have to aggregate the data from a non-biased uh, area. And the non-biased area means you have to use technical analysis because what you want to see is what is the position of the market? How does the market think? And that's the only thing that matters is how the market thinks about an outcome. It doesn't matter about a single expert. A single expert will just get you into trouble because they're not going to be able to accurately read what the market is telling them unless they know technical analysis. That's one of the pillars of the 3 pillars that I integrated. What I did is when I came up with the 3 pillars, the ratios, technical analysis, and market conditions, which is basically cycles. The market conditions is a function of lending. It's real estate cycle. The business cycle is integrated with the business. The business cycle and the real estate cycle are like this. They're the same thing. So if you know where we're at in the real estate cycle, if you know what the demographics look like, if you know that you're cheap from a ratio perspective of an asset compared to history, and you know that the technical analysis and the people in the markets are positioning to turn this thing upward, and you're at this inflection point that's all turning up, well, then that's your best investment spot. Problem is, when you ask experts, they don't know what I just described. So it's difficult for me to have a conversation with a lot of people, and I can bring them on, but it's difficult for me to have a good conversation with somebody that doesn't know 1 or 2 of those 3 pillars. It's almost like they're blind to where the value is in the market, or they know where the value's at, but they're blind to the real estate cycle and the business cycle, or they're good at one thing but really bad at another. It's very difficult to get across between real estate guys and finance people. And that's where I was missing that bridge between the two when 10 years ago. And now that I've linked it all together, it's like, oh, that's where it comes from. That's where those cycles are coming from and all that stuff. So there's very few people that I would trust their opinion or even gain anything from myself where I learn from. There's very few. And a lot of it that I'm trying to research now is all from a psychological perspective. And that psychological perspective is all about holding longer. That's where the big gains are made. And I'm trying to refine my approach and strategies to the market and refine myself from a psychological perspective. So it's all about kind of refining myself for the future and how I could return even more money than what I have. Yes, I did buy the bottom of 2020. Yes, I'm still riding even through. And I don't know why people are trying to time a recession. You can't time a recession. all it's going to do is you're going to be trying to trade in and out. You're going to have tax consequences, which is going to reduce the number of shares that you ultimately hold for the most part. And if no one can time this accurately, then why the heck am I even trying? I'm not playing the big picture view, and all of the ratios tell me that we should still be in this stuff. And I'll just give an example. We'll do crude oil divided by gold. So here's crude oil divided by gold. Whoops, forgot the exclamation. And to me, this looks like an excellent chart for crude oil to outperform gold. You have your falling wedge, the breakout of the falling wedge. You have another squeeze up of a three hump pattern into the corner here. Now you could get a false breakout. Maybe there's a slowdown, we get a false breakout and it does that before heading higher. It very well could, but it doesn't nullify the graph and the chart. The problem that I'm getting to now is I feel like almost that I'm starting to know more than the experts. So it's like I can't go and talk to experts unless they know enough about what I know to get them to the same spot necessarily. There's experts in technical analysis. There's experts in, maybe the real estate cycle, but there's no one who's really combined them. And that's where I really get afraid of getting other people's opinions outside of these guys that have seen many, many cycles, which are very difficult to get. You're talking like the Stanley Druckenmillers and whatnot. But I also think it's possible to beat Stanley Druckenmiller. I think it is definitely possible, but you have to combine kind of a Buffett, Lynch, and these real estate cycle approach all together. And that's what I'm trying to do. My 5-year return so far, when completely implementing all this, has been 41% year over year return. Now, that will shift depending on kind of how this all plays out. And the reason I think it will shift necessarily because we could get a slowdown. And maybe I have one bad year and then I have to go forward. Now, I'm not having a bad year. I'm up 32% this my 1 year rolling returns have been 32% in my account that I'm adding money into. There's other accounts that are down and not they're down from that 32%. They're like up 11 or 12% or whatever. And then there's other ones that are up 20, depending on what I own in it. That account I added more and I don't own as much uranium in it. There's other accounts that I own more uranium in and they aren't doing as well on the 1 year rolling basis. So it really depends on your time frame. My goal isn't to maximize my 1 year return. My goal is to maximize my total return. And if I have a bad year and I'm in an investment where I'm up substantially and I'm not going to sell it because if I still think it's good, I'm going to ride through and keep going. And that's where it's great to be an individual investor because I'm not subject to any type of short-term return. Some of my companies, my largest return, I think, is up 35 times at this time of since 2020, a 35x, and I put a good chunk of money in it. Now my dividends coming from that company are larger than my original position in it. It's crazy to think about. My yearly dividend from that company is larger than my cost basis in that particular company. And I've got a whole bunch of companies. I've got maybe 10 plus companies that are over 10x since 2020. And that's what drove that big return that you see. Now I'm not going to sell them. Those are big positions. And if they don't outperform on a yearly basis, so be it. I'm going to continue to hold them. I'm going to continue to get those dividends. And I think that oil, that's where it's located, this crude oil to gold chart, I think still looks fantastic for crude oil to outperform. And it's possible that I even turn some of those into 100 times, 100 baggers. And maybe multiple ones. Maybe, I don't know. But I'm going to continue to hold them. I don't see a reason to sell them. And with the ratio, if you were to flip this around, guys, with the ratio of gold to oil at 30.9, this has historically been a really good spot to be long in oil. Now, if we do get a slowdown, it's possible that that gold does outperform crude oil, and that maybe it breaks to the upside and we get a big false breakout in a slowdown before heading lower. but I would just buy more up here. I wouldn't sell. So everyone here, like that I see in the comment section, they're basing everything off of price. They're basing everything and their opinions off of short-term price movements. That's not what I do. I look at the big longer-term charts, get a position in it, and then I hold through everything until the commodity bull market is done. That's how I'm doing it, and that's where I'm making all my money. The longer I hold, the more money I make. You really want to know what the secret is. It's deals with taking a long-term time frame. In order to make money in a market, you have to adopt strategies that are different than everyone else. You have to be different. And the reason you have to be different and the reason you cannot stand within the herd is because you need the good entry point. You can't have everyone have a good entry point. You have to take an opposite stance of everyone else to get a good entry point. Then you have to do stuff different than everyone else to get the return. Otherwise, everyone would get these monster returns. The main difference between me and everyone else is my ability to hold longer because no one wants to hold long. Everyone wants to get rich quick. Everyone wants to try to trade their way to success. And if you look at the numbers, trading is not the way to get to success. And in order to be successful, you need to do stuff different than everyone else, which is holding longer, taking opposite viewpoints, and getting the asymmetry in the portfolio. That's the key to all this. And what I do on the website is find those key entry points. Problem is, people might not be able to hold on to them. When you buy low, you're going to have to wait for some time for these to really start to take off. Your risk reward is the greatest when people think it's the dumbest. So I was reading through the comment section. Some people were saying, well, yeah, Platinum's 10-year return is horrible. That's the exact reason I'm there. It's part of the portfolio because no one likes it. They think it's stupid for the past 10 years. And it hasn't gone anywhere. It's basing out. It's a good spot. Now, when do I think it's going to go up? We're going to get a slowdown. It's my guess. I don't know for sure, but will probably be a slowdown. They're going to lower interest rates. Dollar's going to go down, and that's when it's going to rip. To know the sequence of events is very valuable. And I don't even know if a lot of these experts know the sequence of events necessarily. And that's where I don't think I would gain any advantage talking to them. The better, I've gotten far better by not following them. Just my honesty. And the best I've ever done in the markets is when I don't listen to hardly anybody and I stack data on top of each other from all the charts and aggregate it and then use cycles and just do opposite of most people and then buy stuff that people say I'm stupid buying. That's it. And then I just do it over and over and over and over. And then my returns keep going up and up and up and up. And the longer I hold and the more I ride through it and the strategies that I've deployed, I continue to make more and more money at rates faster than even some of these really good expert guys. It's funny, but I don't know. I'm going to continue to do what I'm doing, um, and that's kind of been my approach there. Someone made a comment about Bitcoin in the comments. There's a lot of comments about Bitcoin. Um, Someone asked me, I do invest a little bit in some of these gold and silver mining companies. Why would I take the approach in terms of like the risk? I say that Bitcoin's perhaps risky, and why would I go into maybe some of these gold and silver mining companies? I'll tell you why. Gold and silver are incredibly cheap, and I think they're coming into cycle. We're seeing some of the things that I look at, like the XAU to gold ratio, as coming from a very low point. So if you were to do XAU, which is the gold and silver mining companies, against gold itself, we're at these ridiculously low valuations and they're starting to break the big downtrend line to the upside. The reason I'm taking the risk is because we are at a very good opportune time to do it at. It's not like Bitcoin. Bitcoin, I think, is highly correlated to the NASDAQ. In my opinion, I think the NASDAQ is in a bubble. I think we're very highly valued in the NASDAQ. I think the market conditions that are coming are not going to be favorable for the NASDAQ. So if Bitcoin is more or less an extension of the NASDAQ, it's a more volatile NASDAQ. Why would I take a position in Bitcoin if I think that it is correlated to the NASDAQ and I think the NASDAQ is going to go down? This here has a symmetry to the upside. The other one doesn't have symmetry to the upside. The NASDAQ and NVIDIA, I think they're all in a bubble. That is why I don't take a position in Bitcoin. Also, there's no history with Bitcoin. I don't know how it's going to perform in certain market conditions. We've only been in one market condition. We've been in a recovery phase of real estate from 2009 onward, and we are going into an expansion phase here. So I don't know how Bitcoin's going to react to that. We could get a big downward move while gold and silver go up, which we have a lot of history on. And I choose the probability of success with the outcome, the size of the outcome. So it's probability times size determines my opinions. So I'm not in Bitcoin because I don't know how it's going to react to the upcoming cycle that's coming. It's never gone through it. And I think that it's highly correlated to the NASDAQ, and I think the NASDAQ's in a bubble, and we could go sideways or lower in the NASDAQ. That's why. And that's why I'm taking my chances on gold and silver, is because this is coming into cycle, and we can see it coming into cycle. So that's what I've got there, guys. I'm going to end the thing there. Give me a thumb up for the content. Subscribe to the channel if you guys like. You guys can subscribe to the website. I go over stuff like this. Our entry points, pretty dang good in a lot of these. And I look for technical analysis, I look for ratios, I look for the market conditions to all align in a particular entry point. Pick the entry point, then you have to be patient for this to inflect and get moving. What I would say is, if I were to do that in the NASDAQ, I would have been doing entry points back here, and I'm using NVIDIA as an example. NVIDIA, a lot of these would have gone positive in 08, 09. Your entry point would have been here, here, here. This is your lead-in pattern. It's your pattern there, and we're right here in a lot of companies, right where those X's are. What's coming in commodities is going to be that. But we are just earlier in this phase. We're still very early. So my opinion, if we were to look backwards to look forwards, usually you get like a move higher, and then you get a consolidation. This here could be considered something like an accumulation cylinder as you go up, and then it breaks out. So could NASDAQ or could NVIDIA continue to go up? It very well could. I'm not saying that we're at the ultimate top. It could be at a top. I don't know. And I'm looking for these things to top. Why am I looking? Because the valuations are so ridiculous. They're so ludicrous. And I think at some point it will top. It's going to put pressure on interest rates. And then interest rates will fall, dollar will drop, commodities rip. Just like 2001 and 2. Go back to 2001, 2002. There are companies that just went ludicrously higher. Ludicrously higher. I think that's the same thing that's coming. All right, guys, I'm going to end it there. Give me a thumb up. Subscribe to the channel. Subscribe to the website if you guys like. We still have that Mayday coupon, MAYDAY coupon code that is active if you're interested. But I'm going to leave it there. We'll catch you next time. This is Finding Value.